Welcome to the Accounting X podcast. Practical content each week to help you and your finance and accounting teams succeed in the digital world. Episode 2. Key Risk. Overreliance on IT help to support financial reporting. Financial reporting is a crucial aspect of any business, providing transparency and accountability to stakeholders about the financial performance of the company. To support reporting output, organizations rely on various systems and technologies, including their accounting software, broader enterprise resource planning or ERP systems, as well as specialty repositories such as data warehouses. While offering many benefits, a reliance on information technology or IT systems can also create risk, which senior finance leaders need to understand and avoid. Our guest for this week is Mark Richardson. Mark is co-founder and CEO of Mondial. A qualified accountant for over 35 years, he has also spent over 30 years providing leadership and direction for leading players in the ERP space including SAP, Sage, Epicor, Avalara, and Plex systems. Mark is a specialist in product positioning, messaging and launch management, and has become an established thought leader in the global accounting and financial reporting software sector.
So Mark, we all know that IT or the information technology department becomes the default custodian of anything that's software or tech infrastructure related. So there's also a certain amount of risk, especially coming from departments who have specialized software to fulfill its work. I'm just curious, can you please tell us more about this risk?
So there are several factors that can contribute to the risk of over-reliance on IT in financial reporting. As IT systems are expanded to thoroughly cover more of a company's unique operations, they can become more complex. In many businesses, priority is given rightly to maintaining the required customer-facing processes, including order management, fulfillment, support, and so on. While billing and collections are normally high on this list, other back-office functions, like accounts payable, general ledger accounting, and even financial reporting, can often be relegated to a lower priority. Now, IT controls and oversight are, of course, necessary to ensure the accuracy and reliability of financial systems. However, that doesn't work well when the people making the decisions in the IT group are not in sync with the people in the finance department who are relying on them. This often happens not out of any malicious intent, but when IT is responsible for maintaining the company's entire technology infrastructure, and there are pressures from the commercial side of the business, it's understandable that less customer-facing areas are often pushed into the background. Without a constant flow of communication and prioritization, it's easy for things to slip for the finance group. And then, in addition to those particular risks, even in companies with good internal communications, there's still the risk that due to a general lack of resources, or perhaps inadequate training and support for the resources the company does have, the IT department still can't deliver the output that the finance group requires.
It's interesting. You've mentioned about pretty much all these factors, but what about the consequence of this over-reliance to the IT department?
Well, the consequences of IT over-reliance can actually be quite severe for both the organization and its stakeholders when things go wrong. So let's take, for example, late or inaccurate financial statements. If the IT group struggles to deliver the required reports either accurately or in a timely manner, inaccurate financial statements can be a real possibility, either from the incorrect output that the IT group produces or from the workarounds that the finance department needs to implement at short notice instead. Now, this can all have a negative impact on financial performance. These inaccurate financial reports can lead to poor internal decision-making, which can ultimately negatively affect the organization's financial performance. Management can even become too timid, worried about making further decisions and therefore creating a negative spiral through having access to data in which there's less confidence. Now, this also leads to a loss of general stakeholder confidence because the knock-on effect can be profound. The stakeholders such as investors and creditors also rely on accurate financial reports to make informed decisions about the organization. If the loss of confidence spreads outside of the business, this can lead to a decline in the stock price, reduced access to credit, and even further decreased profitability. And in extreme situations, inaccurate financial reporting can also have legal and regulatory consequences, such as fines and penalties from regulatory bodies or shareholder lawsuits, based on the fact that the information provided is incorrect or inconsistent.
Yeah, but what do you suggest? What would be the ways for us to mitigate this kind of risk?
Well, there are several steps that organizations can take to mitigate the risk of IT over-reliance in financial reporting. Some of them are obvious based on the risks that we identified earlier. This includes improved communication between the finance and IT groups to allow for a better appreciation of the requirements of the finance team regarding the financial reporting process. In fact, this can form part of the training the IT staff receives. It isn't just about the technical ability to manage the finance system and the reporting tools. It's about obtaining a wider understanding of the requirements of the finance team and appreciating the consequences of late or subpar reporting. Now, this is all well and good. However, a different and perhaps better approach would be for the finance system or the financial group to be able to create and maintain their own financial reports. There are cloud-based financial reporting systems available today, which allow finance departments to take full ownership of the financial reporting process and reduce the reliance on the already overstretched IT team. These systems typically work seamlessly with the existing ERP system, so require no upgrades or system changes. They store all of the accounting transactions from the main system, so all the data is there that the finance department needs. The reports are easy to create and maintain and require no technical ability at all, so they present a popular option for non-technical finance staff. The use of these systems to produce financial reports is actually the way forward for modern thinking companies. They reduce the risk associated with the process, increasing assurance in the numbers, initially with the finance team, but ultimately with all internal and external stakeholders. Better, more timely decisions taken confidently are ultimately the required foundation for increased growth and higher profitability in today's competitive marketplace.
In summary, over-reliance on IT systems to support financial reporting can be a key risk in financial operations because it can increase the organization's vulnerability to IT-related issues or failures. If the IT systems used to support financial reporting are not functioning properly or are unavailable, it can disrupt the organization's ability to produce accurate and timely financial reports, which can have serious consequences. Thanks for tuning in to this week's episode of the Accounting X podcast. Don't forget to join us next week for another episode. This podcast has been brought to you by our sponsor. Check us out at mondialsoftware.com.